All right, welcome to Yahoo Finance's morning brief on this Wednesday, April 1st, first day of the second quarter. I'm Miles Ludman. That is Ryan Payne. He is with Payne Capital Management. Ryan, thanks so much for stopping by.
Great to be here.
Let's talk a little bit about the calendar. How do you feel about calendars in general? I think in the news business, calendars are a big deal. We are now in Q2. We exited Q1.
Yeah.
I went through Monday, Tuesday this week, like with the team. We're like, okay, we gotta go through top 5 of this, bottom 5 of that. Like really kind of make a big deal of it. How are you thinking about the setup here as we exit?
Yeah.
You know, again, time is arbitrary, calendar-based end of what's been an eventful Q1.
I personally keep a looser calendar when it comes to my life. But no, I think, obviously when you think about the calendar in the markets, I follow it pretty closely, is you think about earnings season as you come into April. And it kind of, I think, maybe brings back a lot of the chaos back to like, let's focus on the actual fundamentals. And obviously every day, we're just talking about this year, it's like you just wake up in the morning, it's like, what are you missing in the news that you have to catch up on right away? Like at the beginning of the year, I don't think I was going to predict that we were going to invade Venezuela, there's going to be a war in Iran. I mean, the list goes on, but it's just like, you just don't know what's going to happen right now. So I feel like things are more day to day, maybe a little less focused on the cyclical calendar or the cycle of the calendar, as you like to say.
Yeah, well, I guess I'm curious just from so you follow markets, you've got to talk clients through their concerns, people are going to call about this, that, the other. But at the same time, my perception is, and you can correct me if I'm wrong, for me, it's like wake up, hair's on fire if we got more bombs dropped in Iran or Trump says something. Scott Bessent's out overnight in Switzerland. It's like, oh my gosh, we gotta, what's our plan around this? How do you think about those kind of distinct news events which may or may not kind of set off a chain reaction, at least within like your own firm's communication?
Yeah, no, it's a good question. I mean, I think first off, I think you always have to be prepared ahead of time, right? Because let's face it, like no one predicted at the beginning of the year that oil was going to be the place to be, like commodities were going to be the place to be. So I think by like having that proverbial all-weather portfolio, what fascinates me is, every one of my clients hated commodities for years because they did nothing. But I'm kind of like, bad cop. I'm like, you need to own your commodities in your portfolio. So we're having a year like this year where commodities are up over 25%. Energy infrastructure in our portfolio is up 25%. So it's just fascinating to me that as someone who's in the business who thinks about it all the time, is you just can't predict the future. So you always have to have all your bases covered because whatever's going to happen or whatever's going to work in your portfolio, it's probably going to be unexpected. And I find that like really interesting because I'm like thinking at the beginning of the year, like there's no way I could have actually, factored this into my asset allocation. Yeah. And if you think about going into this year, everything was about like, going global with your portfolio. Is the Mag 7 going to start going up again, which we're still patiently waiting for. Yeah. But whatever we're obsessing about tends not to be what's actually going to happen.
So let's talk about the commodities part of it because I'm curious how you think about decomposing let's call it heavy industry, because I think it's commodities, but you've also got utilities, materials, a lot of things that have worked in there. How you decompose, if at all, like what piece of it is still the AI trade, like it's still a bunch of people buying materials to try to build these data centers, but then there's obviously like all the geopolitical headlines, which have been a huge boon, specifically for oil prices and how you've seen that impacting the stocks of some of the majors.
Yeah, no, it's a really good point. I mean, I think we've gone back to this like old school economy versus new school economy. We've seen that transition. I know I got so tired about talking about, I'm sure you may feel this way as well as a journalist. Like, I don't want to talk about the Mag 7 anymore. I'm so tired of it.
But we'll talk about them in a little bit.
I'm sure we're going to talk about them. Having said that, we are going to talk about the Mag 7. But no, I just think like you get to a point where there's just so much brain damage to figure out, okay, OpenAI is not profitable. When are they going to be profitable? How does that factor into all the spending by the hyperscalers? And are they going to see a return on that investment? There's just so many variables there where I like the old school I guess investment, theme is it's just so easy to understand. It's like, okay, everyone's boosting their defense budgets, right? You've got urbanization happening rapidly in places like Southeast Asia, India, where obviously you need a lot of old school base metals for all of that, right? And all this stuff's been undermined for years now. So you're just seeing like these old school industries, industrialization happening, and you need all the the metals to do that. You need all the different commodities to do that. Minus gold, because gold really isn't that much commercial use. So what's been kind of fascinating here is all this stuff trades super cheap, and around the world too. Like if you look at a lot of the mining stocks, they're in places like Latin America, where a lot of these deposits are. You've had the dollar weaken a lot over the last 2-3 years. So all this stuff has come to life, and it's really the antithesis of this like digital trade that we're all talking about. And I find that like refreshing and it is a component to our portfolio. You get like lots of big dividends, lots of lower valuations. And I just feel like everybody needs to have this in their portfolio. And not to say like the Iran war is a gift from the gods, but as an investor, a lot, since the dollar is kind of strengthened here, a lot of that stuff sold off here, you're getting a nice window here to diversify your portfolio outside the AI trade, which is like, again, it's like everyone's just so over-concentrated there.
It's the phrase you brought up, which, when I left Yahoo for a little bit, went to a fintech where we were investing, and I came back, right? Like a phrase that used to come up a lot was this idea of brain damage. And it's like in an investing context, it's a really interesting one. And we rarely bring it up on this program, but like to me, it's like, so here's my interpretation of it. Here's how I always thought about it, how I think about it now, which is basically like, okay, are we gonna spend huge amounts of our time and resourcing to try to figure out something that it feels like literally everybody else is also trying to figure out, when we could just move on and not have to have a strong view about the best model? Like in this case, the way you referenced it, we don't have to have a strong view on the best model, the best AI research lab, the best LLM wrapper around a healthcare solution, all this stuff. Like if you're a venture capitalist, maybe you need to do that. But in the public markets, like everyone had a view on where Meta's cash flow is going to go, or like whatever it is, how we want to do it. And it's like, why don't we just do anything else with our time? Let's just do anything else. And it feels like you're like, okay, let's heavy industry in Southeast Asia. There's an opportunity that I don't hear about every day. Mag 7, it's like, I'm just going to move on. I'm going to take back the time, as people might say, and just choose to sit this one out in a way. And I think as an investor, you don't hear that often, or we don't hear a lot of investors too often tell us like, we decided that our time was just better used somewhere else. And maybe it's because I'm talking to more specialized people who run a portfolio that's only this or only that, and you guys are looking at full sleeves for clients across all kinds of needs. But I think that concept's very interesting of like, listen, I don't need to figure this out, actually. I can find plenty of other ways to make money.
No, I mean, amen. You're preaching to the choir. And I think it comes down to two things. Number one, I think people forget investing is a low IQ business, not a high IQ business.
That's a good one, yeah. Say more.
Warren Buffett, I think, said that. I'm from Philadelphia, so I keep it really simple. So I think the second part of that is, the index is going to figure that out anyway. It's capitalization weighted, so like 90% of fund managers in the growth space have underperformed their benchmark. So when we sit here and we debate about like, I'd rather own more Meta than more Google or Alphabet or whatever, the index is going to figure it out already for you, so you don't have to do that. So we're like, why are we wasting all this time? And to your point, there's all these other huge geopolitical opportunities happening right now where valuations are much lower and you don't have to think that hard. And I like not to think that hard. That's like my goal in life.
So then let's go back to the diversification part of it. And I guess the way, like in my head, I see that, you probably look at it, the JP Morgan quarterly review slide deck that they update every quarter. That is where I pull my favorite stat from, which is that on average, the S&P goes down at least 14% every year, peak to trough. And that's also the chart where I pull stocks usually go up, because that's the one that shows, goes back to like 83, and I think it's like every year except 6, you have calendar year gains, basically. Or, not just calendar year gains in excess of 10%, et cetera. So in there, I'm seeing the investment quilt, where every asset class is a different color, and you can track all the colors moving around. And commodities last year, right? Commodities, gold, all these things, international specifically, back at the top of the list after spending years just languishing in the bottom. Like, do you look at that and, to your point, you're like, nah, this is just going to come back to me. Like, I can just be patient, and this clearly shows a durable pattern over time where different assets outperform, and I don't need to, again, worry too much about not having nailed every last inch of big tech leads the market, which I think it did, for 3 straight years there.
I wish I could say it's more complicated than that, Miles. It really isn't. It really isn't. And I think that's the other great thing about investing is the compounding effect, right? If you look at international specifically, to your point, underperform every year, and then it became obviously international is going to underperform until it didn't last year. It dramatically outperformed, but you're getting 3-4% dividends for over a decade. So that compounding effect is huge, because you get one big move up in the international markets like you did last year, and now you have all these shares you've been compounding, so that return instantaneously overnight becomes a big return. And I think that, to me, that's great investing. It's not trying to figure out what's the hot momentum trade and how do you play that trade. And if I was that smart, I'd be on my yacht, man. I like talking to you, but but I think it's really hard to figure that out. And I think people who actually do figure out a lot of times, the they get lucky. But I think the fact that you just had such an underperformance such a long period of time, the cyclicality says it's time for the stuff to come back into favor. And again, like commodities is a great example of it. It's just the fact that so many commodities have been undermined for so long because that sector didn't do that well, but now there's this huge catch up, which makes all those investments that much more valuable as a buyer right now.
All right, I want to spend some time talking actually just about your business and like the business of financial advising, the way that's changed.
Yeah, right.
No, I mean, we could do investing all the time. We'll do investing tomorrow, we'll do it on Friday, et cetera. So I'm just curious, like, for one, what millennial clients, let's say your client's under 45, like how that's different from older clients, what they're looking for, and like what the shape of managing money is going to mean for like our peer set versus what I think our parents probably wanted.
Yeah. Well, first off, I think everyone eventually turns into their parents. If you look at millennials,
so it's the same. It's just the same stuff all the time.
Well, kind of because it's like I noticed the shift when millennials, the oldest ones, are in their 40s now. They start looking like their parents. Before that, right? The crypto trade obviously is a younger person's trade. Right? There's not a lot of baby boomers calling me like, hey, like I need to get an Ethereum yesterday. Right? That just doesn't happen. You see with most younger clients, they'll say they probably have a crypto portfolio. They're probably sad they have it right now because it's not doing so well. It wasn't the hedge that everyone promised that it would be. But I also think the other component right now that's really interesting is all this private credit that's been sold.
Yeah.
And I've been doing this for 25 years. And I think it's Jesse Livermore, the famous trader from the 20s, has a famous quote that was, there's no new eras on Wall Street. Stock speculation is as old as the hills. So in my mind, whenever something new or something avant-garde is happening in the markets, I'm just like, okay, what in the past can we learn from this? And private credit's been pitched very hard to firms like mine. And I was just thinking, man, this reminds me so much of the real estate crisis when we had all those mortgage-backed securities where they love to sell you something that has a really high yield. And guess what? It doesn't price, so it doesn't feel like it's volatile, but it's just not priced. And there's gates around when you can get your money out. And when you have illiquidity in retail clients, it's like the worst combination ever. So to me, I saw this happening a couple years ago. I was like, oh, this is going to end up just like the way a lot of these other funds during the financial crisis ended up. Now, I don't think it's systemic for the whole financial industry, but anyways, in these funds, those things, that valuation is just that value is gonna keep just eroding over time. It's gonna keep just deflating, in my opinion. So I think there's a lot of...
You guys didn't feel the need to then go and start stuffing client portfolios with a bunch of this stuff and didn't feel like that had to become whatever, a 10, 15% part. Unless, people can ask for it and you can go and do it, but it wasn't like, seems like you didn't sit there, get the pitch and say, you know what, you guys are right. I'm gonna totally reshape how I put my standard client into some of this stuff.
Whenever I hear something that was for institutions is now for you, don't walk away or run away from the table because it's not gonna end well. So to me, it just felt very much like a lot of what we saw during the financial crisis, and that's where the scars on my back come from, going through the great financial crisis. But if you think about it, going back to this generations of investing, you have two generations now, Gen Z and millennials, that didn't go through the financial crisis, or they weren't old enough to experience it with actually money to work. I started my firm during the financial crisis, so I acutely remember exactly how that transpired. So no one really understands, you've got a lot of investors that don't really understand what a credit crisis looks like. And we haven't had one since then, probably have one at some point in the future, they always happen. So I think there's still a lot of naivete that maybe around some of the younger investors?
I was gonna say, do you feel like there are conversations that you have with, again, a younger client that maybe they're just unrealistic about what, like you say to them, like, okay, we're gonna do this, that, the other, and we think 7%, 8% is like a nice bogey, and they're like, that's it? I was told there would be much more than that in terms of returns. Like, do you feel like there's an unrealistic expectation from a lot of folks in that 35 to 45 bucket around what you can get from any kind of financial asset? Obviously, stock market primary among them.
100%. And the only way they're going to learn is to actually go through some sort of financial crisis. The old saying is, all the sheep will be shorn. So I just think it's got to happen to every generation. For the baby boomers, it was when the tech bubble burst. I'm technically on the cusp Gen X. So I really experienced the financial crisis as well. And actually, I got in right at when the bubble burst, the tech bubble. So I've actually been through two big crises. And also, you can't compare that to the pandemic.
Yeah.
That was
Yeah.
like an engineered shutdown. They added stimulus right away. It's not the same thing as a real credit crisis. Like, that's not the same thing. You haven't experienced real pain. I don't believe it.
Yeah, well, it does.
Yeah.
It does feel like, and I looked at the market. Not to make it like too day to day, but whatever. That's the world I live in. It's like I was talking to whether it's the folks here, like texting my buddies yesterday, the way the market behaved with like a couple of headlines that had sort of been recycled, but were kind of new on like there might be an end to this. The market was just ripping. I mean, the Nasdaq's up 3%, and there's so much memory. It feels like, whether it's from pod shops, which are a big part of that kind of marginal bid, which are mostly staffed by millennials at this point. And then also the retail millennial bid, to your point, that hasn't seen a prolonged downturn other than 2022. And it's like any sign of anything positive, it's like buy everything. Buy everything, buy the worst things actually, because that's where all the opportunity is. And there's just such an ingrained call and response, it feels like, both within the market, but then I think even probably broader. Like, people are going to say, oh, well, the market rebounded after this and that, and you might have a meeting set with them for 6 weeks from now, and they're going to bring that up. They'll be like, hey, market's ready to rip. Like, what are we doing here? And that feels like that's probably a different conversation than it is with a different kind of client who's seen a different amount of cycles.
Yeah, it's like the old saying is there's old pilots and there's bold pilots, but there's no old, bold pilots. And I think like you see that overconfidence.
Every millennial is Maverick now, I guess.
Yeah,
although
exactly.
maybe he's both, I think. Maybe that's the point of the movie.
That's a great analogy. Yeah, but I think that's totally true though.
Yeah.
100%. Yeah.
So I'm curious, another part of this, and I'm just pumping you for information, but I'm like, okay, so I have learned about cost is the only thing that matters, right? Or it feels to me like I don't have any edge investing wise. Only thing I care about is like, I'm just gonna get the cheapest thing I can, and that is how I'm gonna essentially generate my personal alpha, right? Buy the S&P for the least amount of cost.
Okay.
Do millennial clients have any different expectations, or younger clients, around what you're charging them for your services? How do they think about the role that financial advisors play in their lives? Because, my dad is old enough to remember you got to call up a broker and it's $10 to do a trade, and now it's like that's crazy,
good
right?
old days.
And that all rolls downstream, I think, to your firm, and you're in the part of the business that's growing the fastest as well. Like that advisory piece of Wall Street is the fastest growing thing that's out there. So I'm just curious if at all this is, just a different mindset or resistance you see from folks, or how you've changed your approach to these conversations.
Yeah, no, it's a good question too, because I feel like, you have two kind of buckets of advisors. You have ones that are maybe pitching on performance, alpha, and again, the dirty secret of our industry is, well, you can buy an index and it performs 90% of the fund managers, which I always love when some old school brokers, like, it's a stock strategy. Yeah. I'm like, okay, that's the dude or dudette that's going to outperform the index. Like, he's the one who has that inside information, or that gifted insight, we'll call it, not inside information. Yeah. But I think that's a very hard value add, because then that's when you start pitching some of these more exotic products like private credit, that you're getting 10% on, where you're really predicated on performance. And I think that's a dangerous game to play. I think that's one type of firm. The other type of firm, which essentially is the way I've run money, I started one of the big wirehouses, Merrill Lynch, back in the day, which kind of exists as Bank of America now. Yep. They went out of business.
People love to date themselves by referring it to as Merrill instead of B of A, even though it's been B of A Merrill for like 15 years at this point, but you can sound cool by referring to Merrill instead.
It just makes you feel old. Like, that doesn't exist anymore, right? It's like I was at E.F. Hutton or whatever.
Right.
So
I'm a first Boston guy.
So I started there. I left there in the summer of 2008. Then Merrill Lynch went out of business in that fall, so it was clear because I left the firm. Bad joke. But I think the real value add as an advisor is giving holistic, and which is kind of overused, financial advice. Like, people want real advice on their money. Like, they want retirement projections run. They want to figure out, how am I invest my money? How does it correlate to my goals? What are all the other facets of my financial life that need to be addressed? So it becomes a very, very, it's almost like the Ritz-Carlton of your money. Yeah. You want somebody who's like very, very service oriented. And actually, most of my advisors are millennials, which it's an old industry. Like, there's 100,000 advisors like me, older dudes, that are going to retire in the next 10 years. So there's actually really like a big gap in terms of employment there. But I think the bottom line is, like, if you're not giving real holistic financial advice, then you got to justify your fee, and that's a hard place to be. But if you're actually giving that real advice on their money, and also just like simple diversification. Like, how many people have commodities or energy infrastructure in their portfolio, which is a cheap hedge, by the way. I buy them as ETFs.
Yeah.
Whereas other people are going out and buying like private credit and all these quote unquote alternatives, which are supposed to be hedges when the market goes down, and they're even more of a disaster. So I think it really is about like the foresight with your process and how it ties into, again, your goals. And I think that people like put a shingle out there as they do financial planning, like every insurance person, but they don't really do it. They just want to sell you a product and charge you a commission, like you said.
Yeah.
So that's like the difference. And I think that's where you're really impactful and you do a great job for people versus like, you're just a product salesman selling something for commission, hoping to get paid.
Well, it's like one of these things where, you'd be surprised how many people send their kids to private school, but like haven't really thought about how that's going to impact them financially, or like, okay, you can afford that now. Can you afford that for like the next 9 years when this is like $1 million tab over this amount of time? Or it's stuff like you drive around, you're like, how does everyone afford these cars? And I'm always like, they don't. People just buy stuff they can't afford. And so it's like a lot of people probably just need someone to be like, hey, let's be realistic. Like, here's the cash in, here's the cash out. And if you're spending this, that, the other on this, that, and the other, like, you might not have as much left over as you think. I think the nominal dollar game of like, I make whatever the high number is, and at the end of the day, I've got a much lower number than I thought. Some people just, or it feels like a lot of people just can't get their heads around that kind of math. And I guess that's really, something that this younger generation that has a lot higher nominal incomes than their parents did, like, I think a lot of people just need to hear that, of like, hey, this isn't gonna go as far as you think, that's okay, but like, these are the decisions that are available to you.
Yeah, I think that's part of it. Also, it's just like exploiting every tax strategy available to you. There's so many simple things you can do from a tax perspective, where it's like, Roth conversions, backdoor Roths. If you're, there's more small businesses opening every day in this country, like a record high for that. Like, what kind of plan can you set up for your business, right? So there's just a lot of things you can do from a tax perspective that aren't complicated, that aren't illiquid products that these big brokerage firms want to sell you. That you can solve a lot of these problems. So I just love a simple versus a complex solution. And to your point, just like figuring out how much you need to be saving. What's your saving strategy, Miles?
Mine?
Yeah, I'm curious.
Well, right now we're saving for a house project. So it's basically as much cash as possible after you max out your 401ks. And I'm actually switching away from a Roth because there are some, that's like a very simple minor tax thing you can do. I've only ever been Roth. But I've kind of looked at it.
You're like a higher earner now, right?
Yeah, well, it's like
bucks now,
right. It's like you're trying to find ways to double, it's a double W-2 household, and it's like really, and we own one house, so there's nothing that I can really do outside of like very small, whether it's an FSA kind of thing. We kind of explored HSA, but I don't know, the 2 little kids, whatever. But yeah, save as much money as possible, and then in 3 years take the whole back of the house off, and hope that like the world is fine, I guess. I guess that's the strategy. But that's good. You got more out of me than anybody else has so far. So now the audience knows what's going on with me. Unfortunately, we'll leave it there. Ryan Payne is the president of Payne Capital Management, also hosts the Pain Points of Wealth podcast. Ryan, thanks so much for stopping by. This was a lot of fun.
Great to be here, Miles. Thanks, man. Great.
All right, coming up next on Yahoo Finance, we have Brian Sazi and Opening Bid. Much more to come here on the first day of the second quarter of 2026. It's funny, so I
didn't mean to
Good Wednesday morning. Welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi, coming to you live from our New York City headquarters studios. Actually, in our studio today, here's what's on my mind right now. The word of the day, at least for right now, is optimism in the markets. That after President Trump suggested the war in Iran could end within 3 weeks. The president is slated to address the nation at 9 p.m. today. Markets around the world trading with a bullish bias in the wake of these comments from the president. I caution you, though, that if you are one of these bulls, this is a news-driven market, and the news in Iran is literally changing every 10 minutes or so, it seems. I didn't like the quarter or outlook out of Nike last night. Meanwhile, more on this stock plunge shortly. And Mag 7 bulls enter the second quarter bruised after steep pullbacks in the first quarter. Oracle's mass layoffs and botch job on the messaging don't exactly scream bullish for the Mag 7 trade out of the gate in the quarter. At least that is my opinion. On the Opening Bid Roundtable today, Peter Berezin, BCA Research Chief Global Strategist and Director of Research, Adam Coons, Winthrop Capital Chief Investment Officer, and Yahoo Finance Senior Reporter, Inez Ferre. Inez, I want to get over to you out of the block here. Eyes remain fixated on oil. We saw oil trade off on these comments from the president. What's the latest here?
Right, the president saying that it could be another 2 to 3 weeks, also indicating that Iran wants a ceasefire and that the U.S. would be willing if the Strait of Hormuz were to be open. And that is really the question here, whether or not the Strait of Hormuz will be open if the U.S. decides to pull out of this war. And you're seeing oil prices right now that are slightly lower, but they're still around $100 a barrel. You have B of A that came out with a note this morning that is saying that they are seeing a mild stagflation, the risk of mild stagflation if oil stays around $100 for the rest of the year, which is their base case. And that is if the ending fights by the end of April.
Peter, let me get over to you here. Let's say the president comes out today at 9 p.m., says we're about near the end of this war. I guess the economy goes back to what happened prior to the war, reaccelerates, stocks go, hit new records, right?
Maybe not. I mean, the problem is that the president has been declaring victory now for 3 weeks. It's really more of a question of what the Iranians are going to do. They clearly want to avoid a situation where they get bombed 6 months from now, especially after the midterms. So they feel that they need to send a message that, listen, if this happens again, we're going to close the strait again. And what's complicating the situation is that there's probably no real true leader within Iran now. There's just a lot of infighting within the upper circles. And the problem is that when you have that, to become the leader, you need to sound tough. And you don't sound tough by saying, okay, we're going to do what the Americans want. So I suspect that this is going to drag on for a while longer.
Peter, what has been the damage to the economy because of higher oil prices and in terms of consumer sentiment as it relates to this war?
I mean, so far it's not visible in the data, but you wouldn't expect it to be that visible yet. We know that this is going to have a major impact on the economy. Gasoline prices are up $1. Diesel prices are up about $1.70 per gallon, and that's going to affect everything from the cost of transport to other important expenses that households face. Fertilizer prices are going up. So this is going to weigh on the economy at a time when the economy was not particularly strong to begin with. Outside of healthcare, we've barely had any job growth now for 12 months.
Adam, let me get over to you here. What do you think this means? Let's take the president on face value that the war will end within 3 weeks. What does this mean for the outlook for rate cuts or rate hikes in this country from the Fed?
Yeah, I mean, I think if we really do get at least a tapering here, it probably means that we're not going to see much out of the Fed either way. Obviously, we've got a little bit of an issue where we're going to get a change of the Fed chairman with Powell leaving. But any short-term blips with inflation, I think the Fed's going to overlook. They understand that, energy prices obviously have a vast impact, but it probably would be short-term if this really does end soon. But like you guys are just saying, it is very unlikely that that's going to happen. So there is a good chance that this extends. Inflation and the possibility of a stagflation, I agree with that, extends, and that would really put the Fed in a difficult position.
Inez, I do wonder, going back to what you said about stagflation, I'm on board with you. I think you're totally right. What does this mean that gold trade comes back into focus?
It does.
Definitely Wall Street.
Oh, sorry.
Go ahead, Inez.
Oh, yeah, definitely. Wall Street is saying that they are seeing gold going higher. I mean, what you saw in gold over the last month, okay, there was a liquidation, there was a sell-off, but they're saying from here it's going to go higher. They're also expecting that the Fed will need to turn dovish at some point, that at some point this is going to be about a growth story and that you're going to see a softening labor market. You've got Goldman Sachs that's still expecting 2 rate cuts by the end of this year, a total of 50 basis points, because they are saying that you are seeing a softening labor market. And if the Fed has to choose, they're going to choose that.
Adam, Mag 7 didn't have a good first quarter. NVIDIA didn't do great despite glitzy GTC. Gold didn't do good. I mean, these were trades that dominated 2025. If this war does end, should investors go back to these names that worked so well last year here in the second quarter?
I mean, they should be giving it a hard look. I think the difference this year from last year is that it's not going to be a market where high tides lift all boats. So there aren't going to be this vast, winning pool of AI players. Something like NVIDIA obviously is big in the space, so probably be a winner. There's some other names we like. I think if you go down the chain and start looking at different software names, those have really been beaten up, and they were all kind of beaten up the same way, even though they're not all the same. And we do think that there are some AI stories where it actually is an enhancement to the business model, not death to the business model. So I think you look for those names, and those eventually will be the winner. I think volatility is here to stay for the near term. So it's not going to be this just rocket up if we do get some reprieve in the conflict. I think there's still many, many things outside of it. Obviously, there's focus on this conflict in the Middle East, but there's still a lot of other economic and kind of macro issues that I think are going to add to volatility this year.
Peter, you've written a lot about how AI is powering the economy. I think you just wrote about it in your latest Outlook piece that I really, really enjoyed. On the one hand, we had Oracle sending people, 20 to 30,000 people reportedly, emails at 6 a.m. say, hey, you're fired, get your ass out of the building. That was yesterday. That continues here today. But then you had OpenAI raise, $122 billion, largest ever capital raise in Silicon Valley. What is the state of AI growth in this country? At the same time, we were still going through a war. Is it continuing at the pace it was last year?
I think investors are becoming increasingly worried about the magnitude of the spending on data centers. In Oracle's case, it's a real concern because Oracle now is negative free cash flow. They're spending more money on CapEx than they're generating in operating earnings. And so they're increasingly reliant on external finance.
Yeah, I think, Peter, we briefly lost your audio, Peter. Let me get over to you, Adam. Peter was talking about Oracle and these mass layoffs. Is that a warning sign that the Mag 7 sell-off that we saw in the first quarter, that is justified here at current levels?
Well, I'm going to go back to, I think it is stock and company specific. Oracle is its own kind of animal. And, that was a stock that we saw really hype up what they were going to do and how they were going to do it. And then, it's the worst thing you can do on Wall Street, which is overpromise and underdeliver. And that's what they did. And you saw that was one of the first stocks to sell off. They're raising a lot of debt, and they were already fairly levered coming into this cycle. So I think that they're a one-off story, and I think you're going to have other one-off stories like that. But I don't think you want to kind of loop them all in together. Oracle has a lot of headwinds, so it's one I would stay away from. But I think there are other opportunities where, like I said, this is just really a story with Oracle and some other specific kind of AI stocks that have kind of, like I said, done that overpromise, underdeliver.
Inez, I don't think Oracle's done here. It's a company that had, over 160,000 employees. They're powering AI. I think they're just getting started on how many people they're going to lay off, and especially as they try to now focus more on their free cash flow. But I know you're also taking a look at all things Polymarket this morning.
Yeah, so I was taking a look at all things Polymarket with respect to the S&P 500, Bitcoin, and also gold, as you mentioned earlier. And if you take a look at what bettors are expecting for this year, they're expecting gold to outperform the S&P 500 and also Bitcoin. So they're expecting gold. And look, you've got 18% that is saying that the S&P 500 is going to outperform this year. So it's interesting that as you're talking about this broader theme about the Mag 7, about tech, which makes up so much of the S&P 500, that there is not that much optimism that that will do better vis-a-vis gold or Bitcoin.
Peter, let me get back to you. I think we got your audio sorted out here. If I read your note correctly, are you still looking for the S&P 500 to finish the year lower compared to where it is today?
Well, I mean, I wrote that the S&P was due for a bounce, and we've seen a bit of a bounce. But I do think that it's a bit like a ball bouncing down a set of steps. It's going to end up lower in the end, even if it temporarily goes higher. Because I do think that A, the economy is weak and probably going to weaken further. And B, the whole AI trade is starting to unravel. We saw that with software. I think increasingly we're going to see it with hardware as investors reach the conclusion that we can have an AI-powered world without trillions of dollars in data center spending.
Peter, if you've done a lot of work on how AI is impacting jobs, we're going to get this jobs report later this week. I've been reading a lot of surveys that are suggesting more corporate use of AI in the workforce. And this comes alongside, we see big tech driving a lot of layoffs. I think this is a tip of the iceberg. Like, how severe could the job loss be as a result of AI?
I mean, so far, a lot of the job losses come from companies that are cutting staff in order to have more money to buy NVIDIA chips. In terms of actual efficiency gains, we're starting to see that, but I wouldn't say it's broad-based yet. If you look, for example, at a chart which shows the degree to which particular industries are seeing a lot of AI usage versus job openings in that industry versus employment growth in the industry, you don't see a strong correlation. So I think those efficiency gains are coming. I don't think we're seeing that in the data quite yet.
All right, Peter, Adam, and Inez, stick with me. We are just getting cooking here on Opening Bid. For more Polymarket odds, you can scan the QR code on your screen to go to the Yahoo Finance Prediction Markets Hub, powered by Polymarket. Coming up, I'm taking Hershey and Nike to task. More on all this next. have to get a shout out to Brad Reese. Brad, I thank you for setting the table for Hershey to be my stock of the day. I'm still digesting Hershey's Investor Day, which was all day Tuesday, a real saga. I liked hearing a lot about new products coming in the snack category, but I really liked that Hershey is ditching fillers in iconic products like Reese's and recommitting to milk and dark chocolate. This comes after HB Reese descendant Brad Reese took to LinkedIn on Valentine's Day and ripped Hershey for using ingredient fillers to boost its profit margins. Reese said at the time Hershey wasn't living up to the Reese's high quality name. Now, Hershey recently, moments ago, sent me a statement reiterating everything I just wrote in my story that's now on our homepage. And Brad Reese is posting a lot about me on LinkedIn saying what Hershey was doing was creating a lot of brand risk. Again, a lot going on. I go into more on this on my Instagram account, so check that out after my show ends today. But let me put this to the opening bid roundtable. Buy, sell, or hold Hershey. And as I know, you're not going to tell me buy, sell, or hold. However, at the end of the day, this is a defensive stock in Hershey that hasn't been doing well right now at a period of really strong market volatility. And look, I'm surprised.
And when input costs are going up, look, I will tell you what the street is thinking. You've got 6 buy, 18 hold, and 1 sell on Hershey right now. But the fact that they are going towards classic milk, dark chocolate, the fact that they are leaning into healthier, what consumers want. Consumers will pay more for something that has not as much sugar, less sugar than some of the products that are out there. So this is all leaning into the right direction of what consumers are asking for.
Inez, I'm tired of this crap that is shrinkflation. I mean, I open these candy packages, Inez, the product sizes are down. The products don't taste the same as that when they tasted to me like in late 80s, early 90s. Like at some point, this has to stop. I mean, Hershey was using something called compound coatings, Inez. I don't even know what the hell that stuff is, but it sounds horrible.
I have no idea what it is, but I will tell you that people will pay more for things that are. Why would you buy that if you are still paying a lot of money anyways? Because these candy bars are like $2.50. They can be $3 now at the grocery store. So why would you pay that if you can pay for something that is healthier? And to your point about shrinkflation, I saw this firsthand when a little kid the other day took this little snack that was one of these little Dorito things, and he's like, "This is so small." And I thought to myself, wow, this kid is even noticing the shrinkflation.
Amen, Inez. You're my new food correspondent. Thank you, Inez. Adam, let me get over to you here. Look, I'm going to check myself because I just mentioned a lot of these consumer staple stocks. I've grown up, and I imagine maybe you too, thinking stocks like this, they pay a healthy dividend. They are safe havens. I think it's time to just put to bed end this view that consumer packaged goods and especially food companies are safe haven companies because they pay dividends and they have steady income and revenue. That's really no longer true in terms of revenue and profits. I mean, they're being attacked by GLP-1s. The consumer's under pressure. Inflation is sticky. Like, what in the world would make these safe havens?
Yeah, I mean, the difficult thing is it seems like the consumer has gotten pickier. And so that adds to the variability, and they are more volatile. The cash flow isn't there like it used to be. And that's a large part to the input cost. So I get the shrinkflation thing, but as a executive of any of these companies, they've got to try to find some way to squeeze margins out. And I would agree that trying to go down market is not the right way to do it. I think you want to go up market. And so I think that's really going to be where you're looking for the traditional staple consumer good, where you're looking for more steady cash flow. Contrary to maybe the way it used to be, in this new regime, it's going up market because, you hear about it a lot, but the K-shaped economy is real. And so trying to go towards those higher end consumers, they're stickier, they have a bigger wallet, and they can kind of be more resistant through kind of economic fluctuation. So I think it's really smart for Hershey to try to go in that direction rather than trying to go towards, cheaper goods. And
you know me, this story like this is tailor-made for me. So I dropped a Sazi fun fact. Let's throw that on the screen here. A little fun fact on Hershey. There I am. I mean, I'm smiling. That's me. I think that picture was taken after I ate a competing chocolate bar. I should note that Brad Reese originally attacked Hershey on Valentine's Day. Stock has traded down really ever since, and despite that big investor day yesterday. But Peter, the stock, like we've been talking about here, is still valued at a premium to the broader market. I mean, do you think it's time to just take these CPG companies off the safe haven table?
Well, that's been the problem with a lot of consumer staples. They've been trading at very, very expensive multiples. Walmart, Costco, even big players trade at a premium to the overall market. And of course, what's happening now is that input costs are going up. If you look at commodities in general, but especially oil and food commodities, like most agricultural commodities are up 5 to 10% already if you look at the futures. That's going to hurt the bottom line of these companies at a time when underlying sales growth is pretty weak. Population growth has really slowed. The job market is not particularly strong. So this is not a great environment for a lot of these companies. They're generally safer, so they're probably not going to do poorly in relative terms, but in absolute terms, they could still struggle.
All right, staying on all things consumer, Nike stock is getting smacked around after a rough quarter and not so great outlook. Important to me here with Nike is that it called out an uncertain cost outlook, surprise weakness in Europe, and a modest growth in fall order books, likely because of cautious consumers. I should say a modest fall in sales, that is. My question of the day is this: did Nike just give the market a taste of what we will hear from corporate America this earnings season? Peter, what say you?
Yeah, I mean, I think consumer discretionary is probably the last place you want to be right now because households in the US, households around the world are going to be spending more on energy products, which means that they're going to have less money to spend on other goods, other discretionary goods in particular. So this is not a sector you want to be in a weakening economy.
I also boiled this quarter down, kind of like what I did with Hershey. Let's throw that up on the screen too. Some areas of concern as you're digging through this Nike quarter. I also put a video out on my Instagram, on my X feed, I should say, this morning, breaking down this Nike quarter even more. But a lot of my concerns are this. I mean, the European business under severe pressure. The guidance really wasn't up to snuff. The China business under pressure. And Adam, I didn't get the sense that this business that is Nike was nearing some form of inflection point. So there are my concerns on Nike. I don't see a lot of these abating anytime soon. What I'm concerned about is hearing some of these concerns from other companies not in the consumer space as earnings start hitting the wires.
Yeah, I would say that this story with Nike is a little bit idiosyncratic. Nike has been a tremendous failure recently in maintaining and propping up their brand name, brand image globally. And so I think that's really what's happening here. Now, we're probably, like I said, the consumer is weakening and you're going to see some of that. But I'll go back to what I said earlier about the K-shaped. I think you're going to still see specialty retail do just fine. But where you've had some of these companies that like Nike that have deteriorated their brand a little bit, trying to go down market. Nike's trying to pivot right now, but they've really blown on a lot of collaborations and different projects that they've worked on. And so I think this is more of a Nike story, more of a brand deterioration story than a kind of holistic retail issue.
Inez, last word to you. The other thing I didn't get a sense from on Nike is how big a lift, if any, will the World Cup be to sales over the next few months?
Yes, and that should be a huge event here, at least for Nike and also all the sports sort of brands. But to the point, look, Nike's last all-time high was in 2021 for the stock. It is in the middle of a turnaround plan. What concerned me and what I listened to in that conference call was oil prices, input prices are going up, disruptions from the Middle East, tariffs. So all of these headwinds at the time that they are trying to go through this turnaround plan. The verdict on Wall Street seems to be you need more patience for this turnaround plan for now, but you are seeing 2 downgrades as of now, Wall Street downgrades today.
I would implore Nike to start making some sustainable shoes, but look how that ended for Allbirds. That business sold for $39 million yesterday. That is absolutely awful to see. All right, big thanks to Peter, Adam, and Inez. Good to see y'all. Appreciate it. A save the date for you, friends. Tomorrow at 8 a.m., a new episode of My Opening Bid Unfiltered podcast drops. I sat down with Insomnia Cookies founder Seth Berkowitz on how his recent sale to a private equity firm may impact the future of specialty cookies. And yes, my healthy self tried one of these Insomnia cookies on camera, and I can tell you this, those cookies did not shrink in size like a lot of the products that Hershey sells. Tune in on Yahoo Finance or YouTube to watch the episode, or listen in on Spotify, Apple, or Amazon. Market Catalyst is coming up next.
Welcome to Market Catalyst. I'm Brooke DePalma. We're now 30 minutes into the U.S. trading day, and let's take a look at all three major averages, because what we are seeing is this return to momentum after we heard from President Trump this morning via Truth Social post that essentially Iran is looking for a ceasefire, that the U.S. will talk if they do reopen the strait, but all waiting to be determined, because if that doesn't happen, he said that escalation will continue. We saw the Dow come off its highs of the day, now up about 0.6%. The NASDAQ, we're going to see if they hold on to the momentum that we saw yesterday, likely continuing into today at the start this morning, up about 1%. And the S&P 500, after its worst first quarter since 2022, now seeing an upbeat start to Q2. This is the first day of trading, not only for the second quarter, but for April. So lots to look out for. The S&P 500 trading higher, up about 0.6%. But taking a look at crude oil, what we are seeing there is a bit of a reversal, similar to what we have been seeing so far this year. Every time that markets are moving higher, we have seen an inverse reaction when it comes to crude. Crude down about 2% today, and Brent, after its largest monthly gain on record, now moving lower, down about 2.5%. On top of that, we also did get a March ISM manufacturing index that did rise to 52.7. The estimate that forecasted was 52.3, so coming in just slightly above expectations there. That is taking into consideration for investors this morning. On top of that, too, we did get a stronger than expected private sector jobs report from ADP and a stronger than expected retail sales report in the month of February. And then optimism continuing when we look at the NASDAQ here. Google, Tesla trying to hold on to momentum that we saw during Tuesday's trading session as well, mostly in the green today. We'll see if they can hold on to this momentum, like I said before. But I do want to take a look at retail, because one stock that is dragging the retail sector lower is Nike this morning. Nike down about 13% to start the day, and Nike has had quite the year. Taking a look over the past year, what we've seen so far is this optimism when it came to the timeline around August, September, but now from that, we're down about 30% over the past year. And Nike now, yesterday afternoon, did issue a disappointing outlook despite topping third quarter expectations. The retailer's turnaround progress being weighed down by ongoing weakness in China. Joining me now is Simeon Siegel. He's Guggenheim Securities Senior Managing Director. Simeon, walk us through exactly what we saw during this past quarter and how this is sort of playing out. Is this reaction sort of overblown here?
Hey, Brooke. Yeah, so I think that it's a good question the way you frame it, because what happened this quarter versus the guidance are two very different things. And so there is no question investors are losing patience with Nike. Right? We're seeing that, and that chart on this very green-looking day, that chart of yours looks scary, and it tells us all we need to know, right? People are saying, I don't believe you. People are saying Nike of the past, Nike's dominance of the past is exactly that. It's in the past. I think what is interesting is if you actually look at the quarter, there is a lot of nuance, and I'm not going to say that it's all green, but Nike North America is growing. People were worried that Nike North America wouldn't grow again. We're seeing Nike North America grow. Now, ex tariffs, gross margins are actually looking pretty good. Ex severance, the EBIT, the operating profit looked a lot better, but they're not telling that story, or at least people don't really buy it, because the go forward number, you still have to worry about all the things that made Nike good in the first place was that they were global. Right now, the global pieces are setting up these other dominoes that people are worried about. And so I think the primary question is, does this guidance set a floor? Is this finally we're troughing estimates, we can make expectations as bad as they need to be and then start building back up? Or is it just pushing the recovery out further? The market's telling you it's the latter.
Simeon, when you do take a look at that guidance, particularly for their Greater China segment, we are seeing expectations that they're going to see sales drop by roughly 20% next quarter. When you hear that, what do you make of that? Is that warranted? Is that a prudent approach? Or are they sort of saying this is worst case scenario here?
So it's always worth asking yourself, we look at guidance as if it happened. They're going to beat that number. Right? That Nike gives low guidance, then they beat it. And so setting a very low expectation, the question is, where do they round out? Today, we're looking at 20. They just came off of doing down 7. The quarter before, they were down 17. And so if they wouldn't have guided, what we would have been saying about China is, oh, you just went from a down 17 the prior quarter. By the way, that was a down 20% in units, because price versus units is important. They were selling much, much fewer goods last quarter. Now that number sequentially improved. So it's still down 7, but that's a lot better, or it's a lot less bad is the right way to frame it. If that's all we had, then we would say, okay, we're really on this great progress. We're moving in the right direction. By next year, China will be growing again, the same way that last year North America had huge declines and now it's growing. The problem is your point, right? The problem is, no, they just told us it's going to get worse again. And so if it does do down 20, then we have to understand, then there's a serious demand issue. If that down 20 is them level setting a bar that they can then beat the same way that they did it this past quarter, then that's going to be another story. And so I think what is interesting is we're looking at America, we're looking at North America, EMEA, this kind of European region, and then we're looking at Greater China. China was the big problem. This quarter was not. EMEA started becoming a problem. We have to see where it goes from there. And so I think what people are looking at is like, how many problems am I going to give you credit for, as opposed to watching you're actually taking care of each problem as they surface.
Now, in a report that Bloomberg just had put out, it said that Elliott Hill, the CEO over at Nike, said that he's tired too of this turnaround progress. He said, quote, "I'm so tired of talking about fixing this business." What still needs to happen? And what's sort of the tie-up? Because we saw the stock run up. Now it's down 30% since September. It seems like once Liberation Day tariffs sort of were in the rearview mirror, the company was able to get ahead. Now we're hitting this halt again. So what's the holdup here, Simeon?
So I think you can take quotes and decide where we want to take them. I think Elliott still very much believes in the business. I think the line you said, he's tired of talking about it, right? What's interesting about Elliott vis-a-vis, if you think about different types of CEOs, there are CEOs that want to get stuff done and there are CEOs that want their name out there. Elliott's not the latter. He's been thrust into that spotlight because of how high of a level Nike was. But if we think about the prior from whatever, $15 billion to 45. So I think what that line, my guess is, I don't want to put words into his mouth. My guess is what he's saying is, it's getting very tiring, have to talk about this. Let me just do it. But maybe that's not the case. But so I think that is an interesting point. But I think what we have to do, listen, there is a lot of pieces. It does feel a little bit like whack-a-mole. And that's why the stock is showing us what it's showing. And I think for better or for worse, or reality is the tariffs are here. If the tariffs weren't, I think you and I would be talking about a North American business that's growing sales and profits after people thought it wouldn't. And that would then give people at least comfort and that they could do it again in China and in Europe as it happens. On the other hand, because you can't show that, because tariffs are weighing down North American profits materially, people are looking at this and saying, well, nothing is fixed yet. And if nothing is fixed, then it is whack-a-mole. And so I think that's probably what he's seeing. He gets to see the nuance and say, no, my underlying business, North America, actually is healthier. And therefore, I feel pretty good about what I can do to fix the problems as we go forward, which was effectively the tone on the conference call last night. But it very much becomes a burden of proof on execution because, unfortunately, those tariffs, and they put out a lot of severance and didn't one-time it out like most companies do, made it look like the profits are being pressured as well.
Simeon, 30 seconds here. Is this a red flag for what we could hear from other retailers about tariffs?
So it's a good question. I think that the reality is this right now is Nike specific. I think we know the tariff pressures that we are getting. Nike, I think, is more at the tail end of an earnings report than the beginning of an earnings quarter. So I think right now that's okay. I think what we saw last quarter, by and large, was an acceleration in revenues across retail and then maybe a pressure point on costs. And so they felt AUR, they got price lifts because of tariffs, but they also absorbed some of the costs. I think we'll see kind of an ongoing version of that.
Simeon Siegel of Guggenheim, thank you so much for joining us this morning. Appreciate your time.
Good to see you.
AI startup Anthropic is racing to contain the fallout after an accidental leak of its source code. The company attributed the leak to human error. Now Anthropic representatives are using a copyright takedown request to force the removal of more than 8,000 copies and adaptations of the raw Claude code instructions, according to the Wall Street Journal. The accidental release came into light in a post on X, linking to the code and garnered more than 30 million views. The leak has touched off thousands of posts online, but people saying they've scoured the code. The accidental release marked Anthropic's second security slip-up in a matter of days. But the company says no customer information was released. However, security experts are warning on vulnerabilities now that the code can be studied. And coming up, all your markets action ahead. Stay tuned. You're watching Market Catalyst. U.S. stocks are rallying yet again amid hopes the war in Iran will soon come to an end. The president says the U.S. will be leaving in a matter of weeks ahead of his planned address to the nation tonight. But is the market getting ahead of itself? Joining us for more is Liz Ann Saunders. She's Charles Schwab Chief Investment Strategist. Liz Ann, are we getting a bit too optimistic here?
Maybe.
Okay.
Maybe not.
Maybe not.
Now, tell me what the next post is going to be, what the next narrative change is going to be. I think there were perceived lessons that were learned in the first week of April of last year when the April 9th announcement of the 90-day delays, the whole notion of TACO. And I think that has been ingrained in a lot of at least shorter-term traders' mindset. What's different, of course, about this time is that even if the war ends, whatever the heck that looks like, right, the dislocation and disruption associated with the Strait of Hormuz, not just in terms of the feeder of energy to various regions, but everything else that goes through that strait, the fact that stockpiles built up, production has been shut down, not to mention some of the military conflict bringing out other production, particularly in LNG out of Qatar. It's going to take a while to bring that back. So I think the economic ripple effects wouldn't immediately be behind us. I think that's something that's going to still have to be assessed.
So do you think that investors right now aren't taking that into consideration? And do you think maybe this could be the sort of Q3 where we could even see the ripple effect?
This is a very important earnings season coming up because analysts have not done much adjustments to estimates based on the implications of the war. We've seen an increase in 2026 estimates, largely because of upped estimates for the energy sector. Duh.
Right.
And a pretty significant increase in technology estimates, but largely concentrated in just two stocks, Micron and NVIDIA, caused those estimates go up. For the most part, though, analysts are not making many adjustments, I think, until they start to hear from companies. So I think that's the next phase we have here where we might be able to put some meat on the bones in terms of the impact of this war on actual companies.
If you're an investor and you're looking at this market right now, you're trying to take into consideration all those posts that we're getting, take into consideration the president speaking this evening, how do you sort of think about, okay, how can I get into this market while there's so much uncertainty, so many unknowns of when exactly this will all end?
Well, I'm glad you asked me the question with a couple of specific words in there, get in. And I always say neither get in nor get out is an investing strategy. That's just gambling on two moments in time,
right?
Which I don't think investors should ever do that, let alone in today's unique set of circumstances. Investing really needs to be a disciplined process over time. I know it doesn't make for good fin TV to talk about why diversification matters so much, why rebalancing matters so much, but that's really what we're talking about. I love to do jigsaw puzzles, and this is a big puzzle right now that we're dealing with. And I often will pose, a rhetorical question: what's the most important piece of a jigsaw puzzle? People will say the corners or the final piece. And I always say it's the picture on the box. That's the plan. And so that's the way to navigate through this, is to actually have a long-term plan, strategic asset allocation, use diversification, use rebalancing strategies, without having to try to sort of pick entry and exit points, especially in an environment like this where narratives can change literally on a dime.
When you see so many investors maybe rotating into energy right now, rotating into utilities, how do you create this diversified portfolio while also thinking, okay, what about those AI concerns? What about the private credit concerns that we had back in Q1 that got overtaken by this conversation of the war?
Yeah, I think we've had a strong bias toward quality, and I know that seems like an obvious statement. As an investor, wouldn't you always want to consider quality? But there are times where you want to sacrifice a little quality if you're sort of anticipating a turn out of an economic crisis.
Right.
But we think you want to stay up in quality. The other thing to understand about things like sector rotations have been really rapid fire. Not to mention the fact that be careful about monolithic sector-based investment decision-making, especially given the concentration. We talk about the concentration problem at the index level, less so at the sector level. Communication services, the two main stocks represent between 75 and 80% of that entire sector.
So certainly
even energy, the top two stocks represent more than half of that sector. So this is an environment where you got to go just a layer deeper to understand not only how to think about diversification in the context of sectors or industries, but also understanding the mechanics of the market and what is happening from a short-term leadership shift perspective.
So what are you looking for in this coming earnings season with this all in mind, especially as we are seeing maybe a return a bit to the Mag 7?
So obviously an important earnings season because we haven't seen much of that adjustment yet on the part of analysts to 2026 numbers. So we'll have to see whether there are major pre-announcements on the part of companies, either positive pre-announcements. Those typically would have already happened. Companies like to get the good news out,
right?
Or negative pre-announcements. What particularly industries and companies that have high energy costs as an input. How are they handling that? Are they making adjustments in other areas where they can contain costs? Are they looking at a potential hit to profit margins? And even on those subjects, to your point about AI, that again has to come back into the conversation. It sort of became, second page news.
Right.
But that's, that was the whole story we were all
heading into
obsessed
2026.
with. And even just heading into March.
Right.
The AI disruption story and the combination of I think in the AI space, investors figuring out who's being disrupted, but who are the biggest beneficiaries of that. So certainly once we get through this war, whatever the heck that looks like, I think there's going to be a shift back to, okay, what were the fundamentals we were grappling with? How do we think about profit margins? How do we think about valuations? The good news about going through a corrective phase like this, in this case in particular, is it was all valuation compression because we haven't seen the deterioration to the underlying denominator in the PE equation. We'll have to see whether that stays part of the story once we get into reporting season.
Well, busy start to Q2 to say the least. Liz Ann Saunders, thank you so much for coming in studio.
Nice to see you.
Appreciate it. And coming up, we're taking a look at some of today's trending tickers. Stay tuned. You're watching Market Catalyst. now time for some of today's trending tickers. We're watching RH, Restoration Hardware, Boeing, and Lockheed Martin, and Conagra. Markets and data editor Jared Blickery joins me now. Jared, let's kick things off with Restoration Hardware, because those shares in the home furnishing retailer are plunging after this weaker than expected guidance that the company put out. Now, the stock is trading down 22%. From what I understand, that is the lowest that it has been since 2020. Walk me through what's happening here. I mean, I'm seeing a bit of a mixed reaction as well for some of the followers I'm listening to on the street as well.
I'm sure. And so there's anytime you have a big down day, you got to look at what's happening under the hood. But let's go after some of those numbers that really kind of spook the street here. Near-term demand is looking softer than the bulls wanted. That's really what the headline is there. So first quarter revenue guide, what they're projecting for the first quarter, that is down 2 to 4%. And then fourth quarter revenue rose only 3.7% to $843 million. That was a little bit light there. Bloomberg Intelligence, I got a quote from them saying, the outlook for a 2 to 4% first quarter revenue decline following a fourth quarter miss. This just points to a sharp drop in demand that could extend beyond the first quarter.
Right.
Then you have international expansion that's weighing on margins. Citi, which rates the stock a neutral, price target is down to 150 from 183. They're saying that the sales ramp and margin recovery is going to take longer than expected. And then cash generation is still the main bull counterpoint. So that's a decent area right now. It's full year 26 adjusted free cash flow guide is 300 to 400 million. Full year 25 free cash flow was 252 million. Morgan Stanley saying ongoing improvement in cash generation is encouraging, but obviously not enough to power the stock today.
Right.
Since you mentioned the stock, let's go to the Wi-Fi Interactive, and I just wanted to chart this real quickly. This is intraday. Let me just go to a 6-year, and I use 6-year to show you what happened at the beginning of the pandemic.
Remember when everybody was buying furniture.
There was a huge home improvement boom, and it's just kind of been from the upper left to the lower right, which is not what you want to see in a chart since then.
And then you also had tariffs to take into consideration, the impact of that.
Exactly. And what we're looking at now is a heat map of my home furnishing spaces. You can see RH is at the bottom today, but let me just show you. It's been kind of a rough year for a lot of these names.
Wow.
There's a lot of red, a lot of dark red there. So it's been challenging for its peers. And then you have idiosyncratic risk, execution. It's kind of a show me story right now, and it might be that way for the whole industry.
And on top of that, think about it. This has been a worse winter than what we could have anticipated. The weather is certainly taking an impact on that. We did get a note from Telsey Advisory Group pointing to that unfavorable weather in January that did weigh on the quarter. But some are sort of pointing out, okay, there's long-term potential when it comes to those 2027 to 2030 financial targets that they had pointed out. They do expect to bounce back in revenue growth to 10 to 12% in 2027, reaching about $5.5 to $5.8 billion in sales by 2030, but it just doesn't seem like the street is buying it because of all this consumer headwinds that they're up against right now.
Anytime you're at multi-year lows, it's a show me story, and so we're going to have to be shown a few more quarters here.
Right. Next up, let's take a look at Boeing and Lockheed Martin, because the Pentagon has signed a 7-year contract with the companies to triple production capacity for the PAC-3 missile. PAC-3 missile. So when you think about this, tripling production, there obviously not too much reaction on the street, sort of a muted reaction, but Boeing is down about 4.7%. What do you make of this story?
Yeah, so this is kind of an incremental story. So here's the deal. There's a 7-year Pentagon production ramp agreement around this Patriot PAC-3 MSE missile program. And this whole deal is meant to help scale output much faster as demand for air defenses rise. And that's, of course, with all the geopolitical ramp that we've seen recently. So here's what Boeing does in the deal. They make the seeker. This is the guidance piece that sits inside the interceptor that helps it find and hit the target. Boeing had already been set to make about 3,000 plus of these, up to 750 a year through 2030. This framework now points to an even bigger ramp. And here's what Lockheed does. They are the prime contractor for the full PAC-3 MSE interceptor. So in January, Lockheed said that they had a framework to lift this production from roughly 600 a year to about 2,000. This Boeing deal is now going to help solve one key part of the bottleneck. And here's why investors should care. This is really a capacity plus supply chain certainty story. So for Boeing, it supports a steadier defense manufacturing growth lane. And then for Lockheed Martin, it improves the odds that it can actually hit some of those big targets with, no pun intended, with those missile output.
Yeah, and also when you think about it, this is a 7-year contract agreement. That's a pretty long timeline for investors to think about right here. And what we actually heard from Jefferies was that they were sort of saying that this is additional cash neutral Boeing investments throughout the production value stream, also modernizing manufacturing, workforce development, strengthening the supply chain. So lots of sort of tailwinds, so to say, for these companies as well.
The U.S. government spends a lot of money on defense, and let's go to the Wi-Fi.
This is something that we've been seeing over the past month. These stocks gain popularity.
Yeah, it's been interesting because defense stocks, let's go to the Wi-Fi Interactive. Defense stocks have done very well over the last year or so, and that goes back to that, remember Liberation Day when we had that huge rally off of the lows? Right. Defense was one of the better performers there, and in fact, they didn't even take that much of a hit over Liberation Day, so it was kind of like, defense in multiple aspects there. But you can see there's a lot of dark green here in some of these stocks. Here's Raytheon up 47%, but over the last month, we saw a bit of a hit there. So ironically, when the war kind of ramped up about 1 month ago, a lot of these companies that had done so well over the last year, it was kind of like a sell the news story. But that doesn't mean that the thesis is dead. Defense is here to stay in terms of all this spending, and so you got to think, okay, maybe that was a knee-jerk reaction. Maybe we're about to see a little bit of a second leg here, and here's what we're seeing today in that sector.
Right, we're definitely seeing a return to optimism here as we make our way, the possibility that this war could come to an end. Let's get to our last standing ticker, and that is Conagra. The food and snack company is seeing elevated costs from a volatile macro environment. They also sort of pointed out to higher inflation than expected during the quarter. They did trim their full year earnings outlook to the low end of the range. They also said that consumers are just shopping less. They're under this economic stress.
Yes.
This is what we've been hearing about snack brands for years and years. It seems like these companies just cannot get ahead.
I keep hearing that salty is here to stay, and that seems to be the one constant. But yeah, in terms of sugar input, things fall out of favor, and it's a very fickle industry. And then you have the GLP craze, which kind of upset a lot of these staples a few years ago. And I'm going to get to the charts in a second here. Let me just go over some of the earnings stuff. So underlying sales were better than the headline. Organic net sales rose 2.4%, even as reported net sales, they fell 1.9%. Profit guidance still getting pinched there. Full year adjusted EPS now seen at about $1.70. Cost inflation, that's still running around 7%. That's very high for this company. Barclays, which rates the stock an overrate, price target at 21, saying notably management has called out a 10-cent headwind from Ardent Mills relative to its original 4-year 26 assumption. And then you have cash flow and deleveraging. Those remain a support beam there. So the company's paying down debt, or they're trying to anyway, while they're generating free cash flow, which seems to be at a decent clip here, about 105%. But you go to the charts. Let's go to the Wi-Fi Interactive one more time. I'm going to show you what's happening in food today, and you can see a lot of red there. Here's
Hershey's, Unilever, Mondelez.
All those good guys. But check out what happened over the last month. It was just, I'm going to sort by equal weight, so you can see a lot of the bottom row there. These names off by 20-30%. Staples did really poorly over the last month. In fact, they were the worst performing sector of March. I think in part that's because they had picked up in December and January, and they were outperformers, and so they just kind of got sold the most in March. But this is another story where you got to wonder, okay, is this a one-off? Are we going to see Staples kind of lead again where they were in January, February? We'll have to see, but maybe not today, because that's kind of a red picture.
And Jared, this weaker outlook could also be an indication of what we could hear from other food companies when it comes to the impact of this war and rising oil prices. So definitely keep a lookout for that. Jared Blickery, thank you so much. Appreciate your time. And Fundrise is pushing back against a short seller position against the company's publicly listed tech innovation fund. The fund went public in mid-March with the aim of giving investors access to private venture capital across the tech sector. Yahoo Finance's Josh Lipton spoke to Fundrise co-founder and CEO Ben Miller.
Ben, great to have you on the show. Maybe to start sort of big picture, Ben, just for viewers who might not be familiar, just explain, Ben, a little bit more about your innovation fund. Like what are you sort of offering everyday investors, Ben? What's the problem you're solving for?
Yeah, so we created the first public venture fund about 4 years ago. We went to the SEC, and created this investment company that allows anyone to invest in venture capital. And then over the course of the last 3.5 years, we've invested in Anthropic, OpenAI, Anduril, Databricks, Canva, basically among the top tech companies in the country. We have had about 100,000 ordinary investors invest in the fund. Over that time period, invested about $500 million. It grew. Our average client return was about 40% a year. And then we listed it about 2.5 weeks ago on New York Stock Exchange. The fund had a meteoric increase from when we listed it, went up a lot. It spiked last week. It's kind of moderated to a little bit more normalized price. And the whole idea is to democratize investing in the best private tech companies. Private tech has been one of the most important sources of American growth, and yet ordinary people, everyday investors, have not been able to access it, especially not in a low-cost regulated wrapper like VCX.
Your point there being that you have these great American companies, Ben, but they're private and they're staying private for longer. Explain that trend to us. Why is that happening?
Well, I mean, what's amazing is over the last 20 years, private companies can now raise all the capital you need in the private markets. You can raise primary capital. You can raise secondary capital for employees and venture funds to cycle out. So at this point, private markets rival public markets. You no longer need to be public in order to access capital for the company or for the employees. And so since there's no reason to go public anymore, and there's a lot of negatives of being public, a lot of regulations, a lot of drama, a lot of extra work, companies just don't have to go public. So why would they? And so they're not. And so what's happened is over the last 10 years, I would bet you that the top 20 companies built in the last 20 years are all built in the private markets. There may not have been a world-class company built in the public markets, in 20 years. And so as a consequence, American investors are missing out on a really important part of the economy. And that part of the economy is growing very quickly and becoming more and more important over time.
Who is your investor, Ben, in this fund? I'm just curious. Do you have sort of line of sight into the kind of average demo?
Yeah. I mean, our investors are everyday person. The average investment was $5,000. It was 100,000 investors averaging about $5,000 in investment. The average person is in their mid-30s. They're normal, like they work in tech, they work in healthcare. They're just a normal person who previously could never have access to these companies. And so we made it possible to invest in the best companies in the world in a very low-cost wrapper. And now I think it's become more and more important at the moment because AI is a transformative technology. And if investors don't have access to this technology as an owner, not just as a consumer, I think it's going to have very significant social effects.
Ben, we mentioned in the intro this criticism from Citron, and listen, Citron speaks, people tend to pay attention, they listen, and it sounds like what they're saying is, your stock surged, they're arguing, and now trading kind of just way above the net asset value. And here's what they posted on March 26 on X. Again, this was March 26. They said, listen, it's trading at 400 plus. Its assets are worth 19. Simple math, they say. You obviously saw that. What was your response to that, Ben?
Well, that was a week ago. The price is now moderated from it was at $5.50. Now it's about $100 a share. So, basically, what happens in public markets is that lots of people can go long and go short. It's very, very normal in any stock. Typically, there'll be 2 to 10% of short sellers. This stock actually, I think, is only 1 or 2% short sellers, very, very low right now, at least. And so some people like to grab news, and that's basically how they drive their business. But for us, it's not really relevant. It's essentially like when I think about these great AI companies, the rocket companies, these companies are the most important companies emerging out of the private markets today. And if people don't want to invest in them, they don't have to. But I think it's really important that they are able to.
Citron, Ben, they made this direct comparison between you all and Destiny Tech 100. They say it's the same product. And their point is, they face the same issue, they say, and investors, in their words, ended up just getting destroyed there. Is that a fair comparison, Ben, between products that Citron is making?
I mean, I don't think it's very. I mean, there's some comparisons because both of us invest in private tech. I think that company had a different portfolio. So you have a different portfolio. We had 100,000 normal investors before we went public. I think those investors have done pretty well, all things considered. They're up over 100%. So to me, I'm not really focused on where something trades in the short term. Like there was a point when Amazon had fallen 98%, and now it's a $2 trillion company. And so over the short term, the market is a voting machine. Over the long term, it's a weighing machine. I think that really, if you're a long-term investor, you're focused on AI, you're focused on deep tech, you're focused on technological change, then that's what we're about. And if you're a trader, I don't know how to speak to traders. I'm not a trader. I'm not a short-term investor.
Ben, great to have you on the show today, sir. We appreciate your time. Thank you.
Thanks.
Coming up, ETFs you might not know but may want to consider as we kick off the second quarter. That's next on Market Catalysts. Equity ETFs notching a 9-month low for inflows in March. Still, overall ETF volume continues to rise, and there may be more opportunities ahead as we kick off the second quarter. Todd Zahn, Strategas Securities Chief ETF and Technical Strategist, joins me now for this week's ETF report brought to you by PIMCO. Todd, walk us through what areas you have seen over this past week, past month, get hit the hardest?
So I think it's interesting. You've had volatility rise, you've had geopolitical volatility rise, and that has resulted in, as you mentioned, a 9-month low for equity ETF inflows. Well below a 6-month average, well below a 12-month average. Restraint from investors is on the rise. I like that because you're cooling off of sentiment. You're seeing flows out of tech to a pinch, and you're also seeing some money come out of areas like financials too. I think this is all necessary but painful to some extent.
Now, you said within this note as well that this is sort of similar to what we saw last year, of course, around this time now. Let's remind our viewers, this was just ahead of the Liberation Day. Can't even believe that it's been almost a year. So what do you make of that similar sort of move that you've seen?
If you think about the backdrop, 23 and 24 were strong years. And then we got very aggressive on the sentiment front via flows and investor surveys. And then the Liberation Day, the tariffs were the catalyst to what caused the correction. We rebounded great. And then now it's a similar environment where folks were very bullish. And now we just have this kind of war event to wipe out sentiment. So I would expect sentiment to be cooling, equity flows to cool off, and there will be a little bit of hesitancy, right? Is it all clear or not? Right. And I like that because it allows you to rebuild and rally in the back half of the year.
Sort of get back into this market.
Exactly.
And now, and one thing that you did see is industrials lead sector flow since November, I believe. Right. So what do you make of that? And also, is that a risk moving into the second quarter, given that we've seen this strength in the sector?
Right. So there's no doubt industrials have been leadership.
Right.
This is a broad sector, right? You have machinery, in defense, professional services, and whatnot. I look at sector flows as a temperature barometer. It's gotten very, very hot. So I'm worried about the tactical risk for industrials in the second quarter, that maybe you could get a little bit more volatility, a prolonged pullback. I would use it opportunistically. Just be mindful that if you're there in a tactical sense, I would be mindful that you're not alone. It's a very consensus long here. So just stay patient on the industrial names.
What's the timeline look like for the type of investors that you're watching right now?
I would say 3 to 6 months, quarter to quarter, right? Longer term, we still like the sector, but over the next 3 to 6 months, when for some of our clients that matters, that's the risk.
Yeah. Right? All right, so let's take your mindset into the second quarter. What are some ETFs that you're looking at that people might not know?
So one of the exercises we like to do is say, okay, you have the core of your portfolio, S&P 500. We know it's large cap growth, it's AI dominant. How can you complement it, right? So we're looking at risk managed strategies, buffer ETFs, because they protect on the downside. We are looking at low vol ETFs in case volatility remains high. You want to have the low vol exposure. And then we're also looking at thematic sectors, tech, financials, utilities, especially in the actively managed space, to help complement that S&P exposure.
Yeah, and now some of those particular names, there was one that stood out to me, this Invesco Bloomberg Financial Data Providers ETF.
Yeah.
It actually is sort of betting on the exchanges that are looking to get into prediction markets.
Exactly.
So why is that now the time maybe to consider that in Q2?
So prediction markets are clearly getting big. Whether they are having regulatory issues or not, we'll see. But it's a question from our clients. How do we get exposure to this? And so FDIQ, which is from Invesco, takes all the exchanges, right? CME, CBOE, ICE, and one's abroad too, packages them up into an ETF, very niche financial thematic ETF. And that's the way, because those companies are getting into prediction markets. They want to be there. Whether you like them or not, it's clearly an important factor.
Yeah.
And so we look at it as another way to say, hey, you have financials, but it's mostly banks. Get the more thematic exposure from financials via the exchanges.
Interesting. Any other one or two top picks?
I would take a look at TTEQ from T. Rowe. That's actively managed tech exposure because tech is going through a speed bump now.
Ooh, okay, lots to watch out for at the beginning of Q2. Stay tuned. Thanks so much, Todd. Appreciate your time. And coming up, Nissan America's chair on the outlook for the region. You're watching Market Catalyst. Stay with us. Let's get a check on crypto, brought to you by the National Cryptocurrency Association. What we're seeing now as we make our way into Q2, also the first day of April, is a bit of a return to crypto. Bitcoin moving higher, up about 2%. Ethereum also moving higher, up about 3%. And if you take a look over the past 2 days, what we have seen is this larger momentum return to cryptocurrency, with Bitcoin now up about 2% over the past 2 days. To take a look at our heat map, what we're seeing there across the board is green, and intraday trading across the board here, including Solana, which was down earlier this week, now up about 2% as we make our way into today's trading session. And this sort of momentum is extending into crypto stocks as well. We have Robinhood and Coinbase trying to hold on to some momentum here. Not too much when it comes to strategy. PayPal, Circle, they are down. But when you take a look at year to date, this is an industry that definitely has gotten a bit rocked by investors. We have Robinhood, Coinbase down double digits. Robinhood down 37%, Coinbase down 22.5%. So definitely something to watch out for, as we do see a bit of optimism return to the cryptocurrency market. Meanwhile, the New York Auto Show is in full swing, with the automotive industry facing several geopolitical challenges ahead. Yahoo Finance's Prasu Manian is down at the auto show now. Pras, what are you seeing
Thanks
there?
a lot. Yeah, so we're at the auto show, I've seen a lot of good stuff out here, but yeah, we're at the Nissan stand now. The company is in the midst of a turnaround, so they say. I'm joined by Christian Munia. He's the head of Nissan Americas here. Christian, thanks for joining us. So we talk about Nissan, a little bit of issues before in the past, but now things are improving. Talk to me about that turnaround and how that reset is going so far in 2026.
I think it's super exciting, because in the last few months we've had some pretty good success regrowing the business again. And we rediscovered that scale is important in our industry. That scale is giving you the ability to get the cost at the right place and get the product at an affordable price for people to be able to buy them. And we're bringing some really good product. Lately, we've launched the new Leaf, we launched the new Sentra, we launched the new Armada, and all these products are doing pretty well in the marketplace. We've been growing the business with fastest growing brand in retail in the US for the last 6 months. And we're very proud of that. I'm proud of the team. And we're going to keep doing our best to keep that trend.
I think the Frontier might be part of that story too. So Nissan wants to grow sales by 10%, I believe, this year, which is a big move for the company. Yeah. President Trump also talking about the company, positive things to say about you. Very congratulations. He's saying, I'm building more in the U.S. You have a massive plant in Tennessee, I believe. Talk to me about how you're going to improve or sort of build up American manufacturing here in Nissan after already building a lot of cars here anyway.
So we have 3 plants in the U.S. We have 2 plants in Tennessee, one for powertrain, one for manufacturing, and we have 1 big plant in Mississippi. Very proud of our people building the best cars we've ever built. And obviously the U.S. product that are not impacted by tariffs are the one that have been really growing the most. My baby, the Frontier V6 that you can see behind, but also the Pathfinder and the Rogue have been very, very successful. And on the Infiniti side, the QX60. Last week we revealed the QX65. We're very, very bullish on what we're going to be able to accomplish with these cars, all made in the U.S. for the U.S. So you need to understand that when the tariff came in play, obviously we had a plan to localize aggressively, but the tariff was not a bad thing for us because it forced us to really accelerate our plan. And we're around 45% of our volume sold in the US, made in the US. Now we're 60, 65%, want to go to 80%. We're going to bring a hybrid technology to the US. And that's the rule of the game, and we need to build where we sell. There's no magic. We're in a big corporation, and that's what we need to do. Obviously, we have some cars coming from Mexico, and affordability is important. So hopefully we're going to get some good news on the tariff from Mexico, still at 25%, hard to sustain.
I know that the Kicks and Sentra are built in Mexico, and that's kind of a problem for affordabilities. How do you get those cars into the U.S. competitively? And USMCA negotiations are coming up. What do you want to hear from those negotiations to make it such that you can still bring these cars into America because they're cheap cars, people need them here?
We need them in the U.S., and I think that's the discussion we've had with the U.S. government and the Mexican government. I think it's important that we keep the affordable cars, the entry sedan, entry SUVs. Made in Mexico makes a lot of sense because obviously labor rates are a little lower than they are in the U.S. And ultimately, there are a lot of components that we put on a Sentra and a Kicks assembled in Mexico, but the parts, most of them are coming from the U.S. A lot of engineering resource is in Michigan as well. So altogether, it's not a bad thing for the economy, and it's good for the American people because they can afford these cars. And enough of these cars at $50,000, $60,000 that people can't afford, right?
You know, we were talking off air about cars like the new Xterra, even cars like the Frontier. You're trying to make these cars around $40,000, right, to be affordable for regular people. The Versa was one of those cars, which no longer is that dearly departed Versa, right? Under $20,000. You know, it got you around town. What do you tell to Americans that if you're going to make it hard for me to import cars from Mexico, how can I address that affordability gap? What can you do as
I think it's part of the DNA of our product and our brand to be affordable. Affordability, durability, quality, and at the same time have a spice. You know, we're not bringing vanilla products. We're not appliance. We love cars. We're passionate about cars. And it's not only about mobility. It's, you know, the car is an extension of your personality, and I think with the design we have and the product we have, we bring some passion at the same time. With Xterra, we're going to bring that. That's really the DNA of Nissan. Affordability, quality, and the edge, the spice, and Xterra is the new baby we're going to bring in a couple of years. That's going to be the symbol of the turnaround of Nissan and big success and growth in the United States, which is the power engine of Nissan globally.
Yeah, you know, we saw the new Z Nismo over there, the 6-speed manual. That would be my pick. But the Frontier is a good car too. So we're at the New York Auto Show. Talk to me about why this show is so important to Nissan's tri-state area. A lot of buyers here. What are those buyers looking at on the floor here from the Nissan point of view?
I think it's a huge market, and it's also an opportunity for us to celebrate, you know, the new product portfolio we have, the fact that we're bringing hybrids this year on the C SUV, the compact SUV, on the Rogue. This is one of the key markets for Nissan in the United States, a big lease market. We have a lot of very strong dealer footprint in New York, and that's really also an international show. It's one of the few that has remained a big show for us, and we keep investing in it. I think the Z Nismo manual transmission is a little bit of a symbol of what Nissan is about. It's not only about mobility, what I said, yeah? It's about fun, excitement. Obviously, mobility is a key component of it. It's affordable fun that we bring to market.
So I think the three things are building interesting cars that are your passion behind. It's affordability. It's also building in America, right? I think that's the
made in the U.S.
Okay, Christian Mooney of Nissan Americas. Thank you so much for joining us.
Thank you. It's been a pleasure.
Back over to you, Brooke.
Expect to hear a full review of what car we should be looking at for 2026, 2027. So more to say on that. But that's it for Market Catalysts. I'm Brooke DePalma. Thanks so much for watching. More Yahoo Finance ahead.